Bank of Baroda stunned with its margins increasing by 5 basis points to 2.96%, whereas the street was expecting a fall in margins because of this huge 100 basis point cut in the repo rate that the Reserve Bank did in June. The other, positive surprise is the improvement in asset quality for Bank of Baroda. As a result, the credit cost, which is the cost of providing for bad loans, has fallen sharply. Now, the worrying bit is, how does the bank prepare for the next expected credit loss regime, where you have to set provisions depending on what you expect in terms of a loss. The bank has said that their provisions will increase by about 22 to 25 basis points, which means we have to prepare for an increase in the provisioning. For all the short and medium-term questions on BoB, I'm joined by Managing Director and CEO, Mr. Debadatta Chand. Mr. Chand, good morning, and thank you very much for joining us. Many congratulations on the NIMs. That has taken the market by a very positive surprise. Can you tell us what would have been the NIMs if you didn't get that income tax write-in? Therefore, if there is no write-in in the second half, may the NIMs fall?
Latha, good morning, and thanks for inviting me. And let me tell again, we had a good quarter in terms of both top line and also bottom line. And asset quality is one of the best in many quarters. It is the lowest point now. So particularly on the margin side that you talked about, yes, this is a normalized quarter. And in the normalized quarter, what is positive is the NIA growth that the bank has given. So it's something contrary to the market in terms of giving a NIA growth. Yes, there is an impact of this income tax refund, and the gap is hardly 350 crore quarter to quarter. Every quarter we do get something. But if you adjust that also, the impact would be something around 7-8 BPS on the NIM that we have declared global. On the positive, which again I say, apart from the margin that we talked about, the NIA is positive. The cost of deposit is all-time low at 4.91. Last time also I said that we were going to pierce the 5% mark. And I would say that the prudent liability management and the asset management is leading to improvement in the quality in terms of asset also, at the same time protecting the margin also.
Okay, let me just persist for a minute. You are expecting income tax refunds in the coming quarters as well?
It is. Every quarter we do get some amount. Sometimes it is higher or lower. This quarter, it is higher than the last quarter by around 350 crore.
Yeah.
So every quarter we get something, and last quarter also we had something.
Oh, okay. So you're confident that you've seen the worst in margins? Second half will be higher than first half?
See, I said...
assuming no rate cut, I mean.
Yeah. Assuming no rate cut and everything stands as it is, I think we have seen the lowest point in terms of pricing, both on the deposit and also lending, barring the MCLR.
Okay.
At the same time, the impact of this repricing would have happened in the quarter at different point of time. So some of the asset liability, possibly the impact would not have been felt for the full quarter, which is going to be the full quarter next quarter.
Okay.
That's why I said while announcing the bank's result, the next quarter, the margin is going to be range bound.
Okay.
And as far as Q4 is concerned, definitely it would be upward bias.
Okay.
So full year basis, we said the margin would be 2.85 to 3%. That's the guidance.
Yeah, that is flashing as you speak. We have your margins. I just wanted one more word on the cost of deposits. Your bulk deposits are still 17% of your total deposits. Are you, of course, there you have said that your bulk deposits include CDs. Is there a way of reducing the non-CD bulk deposits that can improve your costing?
It is so. If you look at almost like last 2.5 years, we have been guiding that we want to reduce the dependency. Earlier, if you look at a percentage of bulk as a percentage of total deposit, it was quite high. So we wanted to reduce that because it is a volatile component and always there is a price sensitivity to it. Mm-hmm. So as on today, the impact that you are seeing on the margin, the NI, everything is because of the prudent liability management. Mm-hmm. In the current composition of the bulk and CD also, there is a higher percentage of CD, the certificate of deposit. Okay. The term is less and the pricing is also less.
Okay. No, if it is CD, it's not a worry. It is just that you'll have merged it and presented the data. I wanted to know a bit about loan growth as well. Your total advances growth is about 60,000 crores compared to a year ago. But a good 30,000 crores has come from corporate, which is a little unusual. If you see quarter to quarter, your Q1 over Q2, there is a big jump in corporate loans. Why is that? They don't normally pay well, isn't it? MSMEs and retail, the return is better, the yield is better. Which sector is this, and will not that impact margins going forward?
Let me put the context therein. Actually, our overall growth on the advances is almost 13% YY basis.
Yes.
In that, the RAM is almost growing at 16%. The retail is growing almost 17.5%. The agri also has grown at 17.2%. Similarly, the MSME almost at 14%. On a YY basis, the corporate growth is only 3%.
Yes.
Sequential basis, the corporate growth is 8%. So, in terms of the growth of the bank that we are looking at on the advances, be it for Q3 and Q4, the full year again we are keeping the guidance that the same 11 to 13%. And the RAM continue to grow stronger, maybe 15 plus, whereas the corporate full year would be something around 10 to 11%. So in that way, rather our incremental, what you can say, the advances would be more towards the retail asset, the MSME advances, the agri advances, as compared to corporate. But corporate we want to do better than on a YY scale. Sequentially, it is very strong. So there are pockets we are seeing there is a good traction therein, and we typically within the book we look at a core corporate and the refi deal. Slightly on the refi deals we are slightly restrictive because that's a very heavily competitive market with a lower pricing. So we are mindful of the margin, and that's why the what I say now you can very well imagine the NIM at 2.96. That talks about our prudent management on the asset side, particularly on the corporate loan book also.
Okay. Well, it's still, it's eye-popping. Only 3% maybe when you say that, but you look at 8%, 3.7 lakh crore has become 4 lakh crore. So it is a 30,000 crore jump, which which makes you wonder, whether you'll be able to maintain margins. But let me come to asset quality. MSME numbers, of course, keep coming up. They are the highest part of your stress. Are you worried that it might increase? Can you give us some guidance, or are you... MSMEs and agri loans, any worries at all?
No, I don't think so. If you look at the fresh slippage data that we have given, that is almost 2,669 crore. It's lower than the last quarter fresh slippage and also the lower than the same quarter last year also. So that's something that we are talking about the asset quality. Inherently, the quality is really good now. At the same time, if you look at the fresh slippage, the component wise, both on the retail and MSME, it is lower than that of the last quarter. Agree, there is a marginal slippage over there. So in terms of the overall book, in terms of the SMA book, we only declared the more than 5 crore acrylic SMA 1 and 2. But internally, when you look at the SMA book, this book looks quite good. So in terms of the asset quality, I don't think there is any pressure, particularly the segment of...
Not even in agri, which you admitted.
That's marginal. 100 crore for a book like us is a marginal number.
No, I agree.
That's not... No, I mean, at the same time, the denominator is also increasing, you believe. So in terms of the GNPA per se on a component of agri also would be lower than that.
Okay. Let me come to recovery from bad loans. Overall, your GNPA is like a very good picture, nothing to worry. But recovery from bad loans obviously is falling. Should we expect any positive surprise there? Because you have some 42,000 crore in various NCLT proceedings. Is there a positive surprise likely? Because all of them are written off.
See, we said earlier also our normalized the recovery out of TWO is roughly around 700 to 750 crore. And this quarter, it is slightly lower at 483 crore.
Yeah.
But going forward, we want to maintain the normalized. One-off is always contingent upon host of factors, including the processes and many things. Look, the Q2 of last year, we had a significant one-off. That's why when we compare the net profit, we say there is a YY negative. Whereas suppose I adjust that, then the net profit is almost 22% of positive growth this year.
Okay.
So one-off is always, we have a good kitty, but then these are again sticky accounts. But at least one thing that I'm pretty sure that going to be, we can maintain our normalized 7 to 750 crore out of the TWO account, recovery of TWO.
Okay. Oh, that's good to hear. Very quickly, the two major changes announced by Reserve Bank on expected credit loss provisioning. You said your provisions will increase by 22 to 25 basis points, your credit cost, sorry. Exactly what will the impact be, and for how many years will this be, this likely increase in credit cost?
Look, there is a one-time impact and there is a recurring.
What is the recurring impact, sir?
Yeah. Recurring, we said the credit cost can go up by 20-25 BPS once, the ECL...
For 1 year or couple of years?
It may, we'll just look into that. It's a very provisional back of the envelope calculation as on today. One is that I said the impact, ECL impact on the CRAR is going to be 1.25. At the same time, the lower, the RWA because of the credit risk, which has again also being announced, that is going to give a positive almost 60 to 70 BPS. So net to net, it would be something around 0.75 on the CRAR, which would be again spread over 5 years' time. At the same time, the recurring would be the credit cost can be 20-25 BPS. That's why, in spite of all this asset quality that we have announced this quarter, we kept the slippage ratio guidance and the credit cost at the same. The slippage ratio guidance is 1 to 1.25.
Okay.
Credit cost would be less than 0.75.
Okay. So that includes the ECL impact.
I mean, probable it would include that part.
Okay, got it, sir. The final question is on these ECL guidelines. The ECB guidelines. Now, foreign branches of Indian banks can also participate in acquisition financing, and banks also can participate. Of course, they are draft rules. Now, you have, a fair good network of foreign branches. So, say 1 year down the line, when both these draft rules become permanent rules, will you see more money made out of that acquisition financing?
I would not put it as a money made, but then there is a good opportunity for a bank like us to play a significant role therein. We are there in international market, and international market, this is an established product. Okay. So we understand the market, we understand the product. So in that way, once it is implemented, see, we have a large book also domestically. My international book in rupee terms is almost 2,20,000 crore. So in that way, I think it's a very good product that need to have. As India getting into a mature market, I think we need to have this product. And once it's rolled out, I think a bank like us would be having I'll not put as an advantage, but an opportunity for us to play a significant role there.
Okay. Yes, I guess there will also be advantages when deposits insurance becomes market-based. You may perhaps have lower costs, but those are yet shooting in the dark. We'll have a longer conversation some other time. For the moment, the market has given you a huge thumbs up. Your stock is up 4.4%. Many congratulations, Mr. Chand.
Thank you very much. Thank you, Latha. Thank you.
We wrap up on Bazaar on that note. Chartbusters coming.